Hi and welcome to Swissquote's Daily Market Talk. It's Tuesday, September 2nd. Gold hit a fresh all-time high level on softer US dollar and strong global demand, while silver surpassed $40 per ounce for the first time since 2011. The euro, on the other hand, is softer this morning on French political uncertainties, while Chinese technology investors booked their profits following a 20% rebound in Alibaba shares yesterday. So we will talk about all that and more, but before we do, please keep in mind that opinions are my own and this is not financial advice. So the week started in slow motion in US and Canada as markets there were closed due to Labor Day holiday, but equities in China enjoyed prospects of improved ties between China and India, while a 20% jump in Alibaba shares after the company reported a triple-digit surge in its AI revenue sent the Hang Seng Index up by 2% since yesterday before some profit taking took place this morning. Alibaba shares, on the other hand, hit their highest level since April before retreating as well, and the Chinese AI rally has certainly further room to run. In the energy space, while US crude kicked off the new week on a positive note, as softer US dollar and waning hopes of seeing peace in Ukraine anytime soon weighed heavier yesterday on investors than the crumbling hopes of seeing India buy US crude. So the same factors that I just cited here could also help oil bulls break the $65 per barrel resistance to the upside that is being tested again this morning and extend gains to $66 to $67.7 per barrel region that includes the 50 and 200-day moving averages respectively. In precious metals, geopolitical unease and softer US dollar sent gold prices to a fresh all-time high level this morning in Asia. The price of an ounce of gold surpassed the $3,500 mark, the prior all-time high level reached back in April, remember. The move is explained by a softening US dollar, but also by rising central bank and stronger institutional demand for gold as investors around the world are replacing their US Treasury holdings at increased pace by alternative assets. So the percentage of US Treasuries held by foreign central banks has been actually falling from peak levels since a decade, but that migration to gold from US Treasuries accelerated significantly this year amid rising US debt worries with the new Trump administration, the US rating downgrades that followed, the rising debt worries, global trade war, and geopolitical concerns. And this year, for the very first time since 1996, foreign central banks' gold holdings surpassed their US Treasury holdings. And this is something that is quite big and that will have implications globally. Now also note that Indian pension funds are also asking permission to invest in gold ETFs, so demand is not cooling down even with the record high prices. Silver, on the other hand, soared to the highest level since 2011. Both precious metals, both gold and silver, have further upside potential, but silver probably has a bigger potential as the mint ratio, which is the ratio between gold and silver, while this ratio fell to the lowest levels this year, but is still above the historical range of 60 to 80, hinting that silver should, in theory, gain faster for this ratio to return to historical averages. Or gold should ease, but gold outlook remains quite positive at the moment. In Europe, equities posted meager gains on Monday's trading session as PMI data across the Eurozone released in the early hours of the new trading week hinted at a faster expansion of the euro area's manufacturing activity. Now, if you look more in detail, the German figure was slightly lower than expected, just below the 50 threshold, but the figures from Italy and France actually pointed that economies there returned to the expansion zone after months and even after years in the contraction territory for France especially. So the figures that we saw yesterday, stronger than expected PMI figures, helped euro extend gains to 117.36 against a broadly weakened US dollar. Yet the euro sellers rapidly joined in as the widening French and German 10-year yield spread reminded of the ongoing political unease in France and a potential government collapse by next week. So separately, the French accused Italians of fiscal dampening. The latter added a small layer of euro area-wide dimension to the French crisis. But note that the French budget crisis right now is not seen as being contagious, and that's quite good news for the rest of the euro area. So that's a situation that should eventually help prevent a major sell-off in euro and across the euro area assets. Now, the French CAC 40 index remains vulnerable, obviously, to further weakness, but even without fiscal worries, the luxury-heavy French CAC 40 is feeling the pinch of deteriorating global demand for luxury stuff and has been left well behind the Stoxx 600 index this year, where defense, utilities, and banks actually led gains so far this year. And on the index level, the Stoxx 600 index recovered a part of Friday's losses, and any French-related dip could eventually be interesting to buy in for investors who have a positive outlook for the European stocks altogether. On the data front, all eyes are now on the euro area's aggregate CPI estimate for August, as due this morning. The headline CPI is expected to print a 2% growth in euro area prices in August, while core inflation may have eased to 2.2%. Both numbers are very close to ECB's 2% policy target. So a set of numbers in line with the market expectations should, in theory, maintain the expectation that the European Central Bank will be keeping its interest rates unchanged at its September monetary policy meeting, as the policy rate there at the ECB is now just above the 2% mark, so it is not restrictive nor supportive. The next move from the ECB is still expected to be a rate cut, mind you, but depending on the economic data, it may not necessarily materialize this year. The European growth is actually expected to remain tepid, which could eventually justify one more 25 basis point cut before this year ends. Yet, despite the sliding energy prices, a stronger euro that we see today and that helps taming inflationary pressures and easing services inflation, markets assign less than a 40% chance of another rate cut this year, and that probability is down from nearly 50% in July. So this hawkish divergence from the Fed, where we have sensibly higher dovish expectations since the beginning of August, has been supportive of the euro-dollar's rebound since the beginning of last month. But caution, because if European growth remains below expectations, then the European Central Bank dollars could very well return, and quite rapidly. The latest CFTC data actually confirms that the net euro speculative positions have kept rising throughout this year, and I was obviously mostly on hope that the military and security spending in Europe would support the European growth somehow, and on rising US debt and geopolitical worries as well that increase the reserve and sovereign bond demand for the single currency and the euro area bond market. Data actually show that in 2025, central banks and other official institutions have, besides their gold holdings, notably increased their share in the Eurozone sovereign bonds as well. In numbers, official buyers accounted for 20% of Eurozone bond issuance so far this year, and that's up from 16% in 2024. And a survey by OMFIF found that a net 16% of central banks intend to increase their euro holdings over the next 12 to 24 months, up markedly from 7% a year earlier. So in the short run, the euro's appreciation already takes into account all of this information and the global demand that has been rising due to the US dollar's demise. Hence, the crowded long positions that we see in euro today could lead to a certain downside correction in the coming days and in the coming weeks. A reasonable trigger, obviously, for that, for a downside correction in euro could be the French political chaos and worries. But in the medium run, the euro outlook still remains positive due to diversification away from the US assets and a better growth for the euro area as a result of all of this international changes. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please Do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.